So the people who are constantly saying, sell it, take profits, it's going to go back to 50, it's got to go back to this old high here or there or whatever. And then, like a week or so ago, we dropped 15% in silver in like 2.5 days. And a couple of days later, you're back to the high. What are they thinking? Don't they realize that this is not a normal advance? You don't get these multi-month corrections anymore. Now they're measured in days. And frankly, we expect to see silver reach, my minimum is like 200, but I wouldn't be shocked if it approached 500, to tell you the truth.
As we move into early 2026, the silver market has officially entered price discovery mode, smashing historical records to trade above $88 per ounce. This isn't just a rally, it's a structural explosion fueled by a fifth consecutive year of supply deficits and massive industrial demand from AI data centers and solar technology. With silver already up 20% in just the first 2 weeks of the year, investors are bracing for white knuckle volatility as the metal outpaces gold in a historic catch-up move. In this video, we sit down with MichaelOliver, founder of Momentum Structural Analysis, MSA, who has tracked market shifts since 1992 using his unique unorthodox methodology. Oliver argues that silver's decades-long price suppression has finally failed, unleashing a move that could see prices reach a minimum of $200 and potentially even $500 per ounce. He breaks down why traditional corrections are now measured in days rather than months, and why silver is the ultimate monetary wave to ride. But could this be the final coerced mistake of the banking system before a total market reset? Watch to find out. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
We've done a lot of studies in MSA, Momentum Structural Analysis, using our own unorthodox methodology. But again, we've been around since '92, okay? But what's going on in silver now is not normal, and don't expect it to be normal. Most technical analysts, when they analyze any given market, they look back through the last couple of years in that market and they see norms like, excessive overbought, oversold, swing objectives, things like that. And they're still living in that world with silver. And I think they're making a big mistake. Silver as a money, remember, don't forget it's money. It's not just, silver's like surfing on a wave, but it's really on two waves. The one that's the big one is the monetary aspect of silver and gold. That's the major differentiating asset value underlying those metals. But silver also has the industrial aspect, which is exploding because, we know demand for silver in a couple high-tech categories, all the data centers and computers and solar panels and so forth and so on. It's in demand that is outpacing supply and has been for 5 years now. And it continues to increase, meaning the deficit increases. So it's got a real problem in that regard. So that's the other wave that most people are focused on that. The silver demand because of this, that, and the other. They're forgetting it's money. And it's very undervalued to its mama metal, gold, historically. And this is one of the trigger levels that caused silver to do what it just did in the last 8 weeks. The point is that when a market has done something in error, either excessive on the upside or excessive on the downside, in this case for silver, caught in a 50-year range, when you can look at every other market in the world, copper, lead, gold, they weren't caught in that 50-year range. Copper's range was 50 cents to $1.50, and it's living in the 450 level. Now it's 5 something, almost 6. When you stay stuck in that kind of range, and yet silver for some reason stayed in that range for 50 years, despite copper breaking out of its range in 2005, lead in 2007, and gold at each of its bull markets would vastly exceed the prior high. It was 850 in 1980, then it was 1920, and now it's 4,000, et cetera. So why was silver contained? What's going on there? It made a mistake. Now, maybe it was a coerced mistake in effect, manipulation, and we understand that, where the certain banks and association, possibly with central banks, might have been playing a game to try to keep it capped down for some reason. Ultimately, that failed. Okay. But when silver unleashes itself as it has now, I expect in the next couple of quarters since that spread breakout, that probably you're going to see a dynamite move that will drop jaws. It's not going to be incremental. You're going to a new reality. And it wouldn't shock me that it's in several $100s. And, they're like Eric Sprott, I think I gave a talk after he did in Toronto back in October. And he noted that, if you deflate silver or adjust it to the monetary growth, it'd probably be $200. It would be fair just to match the old highs when you factor in the decay and the quantity of the number of dollars in existence. Well, heck, yeah. Well, let's say that's a new normality, a new reality that would make sense. Well, but when markets go from excess, they quite often, one way or the other, they go excess the other way in the process of getting to the new reality. I think that's where silver is right now. And so the people who are constantly saying, sell it, take profits, it's going to go back to 50, it's got to go back to this old high here or there or whatever. And then, like a week or so ago, we dropped 15% in silver in like 2.5 days. And a couple of days later, you're back to the high. What are they thinking? Don't they realize that this is not a normal advance? You don't get these multi-month corrections anymore. Now they're measured in days. And frankly, we expect to see silver reach, my minimum is like 200, but I wouldn't be shocked if it approached 500, to tell you the truth.
In this segment, MichaelOliver analyzes historical midpoint stumbles to prepare you for the next phase of this breakout. Using lessons from the 1979 and 2011 surges, he explains why silver often faces a month-long congestion or a sharp pullback about 3 months into a major move. While novice traders might panic sell at round numbers like $100, Oliver reveals why ratio-scale charts suggest the real electric move hasn't even started. Are you holding a time-sensitive position? Or are you ready to ignore the noise and ride the tenfold expansion toward $500? Let's hear directly from MichaelOliver.
In the middle of those two post-spread breakout surges, where silver broke out versus gold, and it went crazy, okay. Basically, let's call it 2 quarters. They were slightly different in terms of months, but basically ballpark 2 quarters of a move, okay. They went up huge in percentage terms, but in the middle of each move, time-wise, about, let's call it 3 months into the move, okay? You need to get more cautious about a stumble, because at each of those times, there was a midpoint stumble, not like what we just saw, where it was 2 days and over with, which is going to be normal now. We expect to see 10 to 15% swings in silver, maybe by the hour, okay? But 2 days down, and you thought, oh, going back up, and sure enough, it's back to the high 2 days later, okay? But in the middle of both those moves, there was what you could call a correction. I think it was January of 2011, after the September 2010 spread breakout, silver surged. And in January 2011, on price charts, it had a monthly reversal. I mean, it made a new high, but closed down on the month. So all the technicians say, oh, that's a reversal, that's the top. There was no follow through to the reversal the next month, and you really exploded after that. In 1979, in the midst of that mid-79 to January 80 move, there was also a stall. It wasn't a monthly reversal, but it was several weeks drop and then congestion. So, if you've been call options then, time sensitive. Or in 2011, in January 2011, when you had a midpoint pullback, it would have been important to sort of pay attention, especially if you have a sensitive, time-sensitive leverage position. Now, if you're invested without leverage, like in miners or silver bullion, I think you need to ignore it. Don't take profits. It's a midpoint correction. We might get one. I don't know. These dynamics this time, remember, we're outside that box now. Those corrections occurred still within that $4 to 50 range. Okay, so there was a midpoint correction even in those surges. But we've come out of that 50-year range. So, maybe there will, maybe there won't. But I'm cautious that there could be. If you take an arithmetic chart, meaning a regular dollar chart of silver, and go back 50 years, you'll see that range, monthly chart, high, low, close, okay? You'll see $50, $4, $50, et cetera, et cetera. If you take the dimension of that range in dollars, it's like a $45 range or so. Let's call it $50, okay? You add 50 to 50, the breakout point, you're going to 100. And we know that there's a lot of traders out there who like to play these big round number games. Like remember 3,500 on gold? They stalled it for 5 months there. Big round number, 3,500. Let's sell it, sell it. Silver was stuck at $35 for a whole year, late 24 to early 25. Whenever you get the round numbers, they tend to like to play games there. Well, it happens that that's an arithmetic, orthodox swing measurement of silver added to the breakout point. Would say, hey, I'm going to go to 100, which is to double the range. Okay. If you take a logarithmic scale chart, which is far more important here, a ratio scale chart, which again, gold continues to blast out on that, eightfold move, eightfold move. It's just, like that. Silver's been capped. If you take a logarithmic scale chart, you have a tenfold range there, $4 to 50. Take the low price, multiple times 10. Okay. It lived in that range for a half a century. Okay. You break out at 50, what's tenfold? $500. So don't be shocked that this move in silver in the next 6 months or a year, but most of it compressed, I think, again in a couple quarters, could reach something like that. Not the silly arithmetic, everybody sees the chart type move. Oh, $50 will go to 100. That's where you take your profits. So it wouldn't shock me that maybe around that idiot level, you're going to have some game playing. Of course, right now we're trading either side of 80. So, another $20 or so. So I'm sort of ready for that mentally, but I also know that if that occurs, especially soon in the move, like only in 3 months of upside, then you're only halfway through that surge. And this is a midpoint correction on the clock, at least. And it wouldn't shock me that if you go to near 100 or $96 or whatever you want to do, somewhere around there and get a correction, it's when you turn through that, you're really going to go electric. But there could be a correction there.
MichaelOliver concludes that we have officially moved outside the box of the last 50 years, where old technical norms no longer apply. He warns that while arithmetic traders will likely exit at the $100 level, the truly electric phase of this bull market begins only after we clear those psychological hurdles. This isn't just a trade. It's a once-in-a-generation realignment of silver's value. Are you prepared for the jaw-dropping momentum that lies ahead, or will you be shaken out by a mere midpoint stumble? Share your thoughts in the comment section below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.